Ladies and gentlemen, good day and welcome to the earnings conference call hosted by Hi-Tech Pipes Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touch-tone phone. I now hand the conference over to Mr. Anish Bansal, Whole-Time Director from Hi-Tech Pipes Limited. Thank you, and over to you, Mr. Bansal.
Good afternoon, ladies and gentlemen. A very warm welcome to all of you, and thank you for joining us on the Q1 FY26 earnings conference call of Hi-Tech Pipes Limited. I am joined today by Mr. Arvind Bansal, Executive Director and Group CFO, and Mr. Arun Sharma, Company Secretary and Compliance Officer. Let me take this opportunity to walk you through the highlights of our financial and operational performance for the quarter ended June 30, 2025. In Q1 FY26, our revenue from operations stood at 791 crores compared to 866 crores. Sales volume increased to 1.24 lakh tons compared to 1.22 lakh tons in the corresponding quarter last year, demonstrating our sustained market momentum. We recorded an EBITDA of rupees 41.03 crores, and our profit after tax stood at 21 crores, marking the highest ever quarterly PAT in the company's history, a significant milestone and validation of our disciplined execution. On per ton basis, our EBITDA stood at 3,308 rupees, reflecting a notable improvement of 10% on quarter-on-quarter basis, driven by better product mix and improved realizations. Now, let me provide an update on our ongoing capacity expansion initiatives, which will take us beyond 1 million tons of installed capacity post-commissioning. Our greenfield plant at Secunderabad is in final stage of commissioning and is expected to begin commercial production in Q2 FY26. This advanced facility will manufacture specialized ERW pipes catering to infrastructure, defense, and renewable energy sectors, and is set to significantly strengthen our presence in North India. Our brownfield expansion at Sanand Unit 2, Phase 2, is also on track to commence production in Q2 FY26. This facility is being developed as a dedicated manufacturing hub for the infrastructure and renewable energy segments. Encouragingly, we are consistently witnessing strong order inflows from the renewable energy sector, and our special grade pipes have been very well received in the market. This validates our strategic focus on innovation and engineering excellence. We continue to enhance our product portfolio in alignment with market needs and application trends. During the quarter, we added new SKUs across our product categories, enabling us to cater to a broader spectrum of customers and expand our relevance in both infrastructure and industrial markets. Strengthening market presence remains a core priority. In Q1 FY26, we executed our targeted door-to-door campaign across South India and North India, where our teams engage directly with fabricators, contractors, retailers, and architects. These efforts are building brand trust, customer loyalty, and positioning Hi-Tech Pipes as a preferred name in key micro markets. Looking ahead, we remain committed to our vision of achieving 2 million tons of installed capacity by FY29 in alignment with India's accelerating infrastructure and industrial growth. As part of this growth roadmap, we are also undertaking a strategic foray into API-grade pipe manufacturing aimed at significantly increasing our share of high-value precision engineered products. This initiative will be integrated into our 2 million ton vision. Currently, we are in the process of finalizing vendors, technology tie-ups, infrastructure planning, quality certifications, and compliance, etc. With the commissioning of upcoming capacities, deeper penetration into value-added segments, a growing export footprint, and continued cost discipline, Hi-Tech Pipes is well positioned to deliver sustainable, scalable, and profitable growth. We now open the floor for any questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, please press star and one to ask a question. Ladies and gentlemen, you may press star and one to ask a question. The first question comes from the line of Nishant Gupta from Manvara Capital Research Solutions. Please go ahead.
Hi, sir, thank you for the opportunity and congratulations on posting the highest ever PAT. I wanted to understand first, the new capacities which are coming live from Q2 FY26, what are we expecting in terms of the top line, and how going forward we see the contribution of value-added products in the future? If you could clarify this.
Yeah. Good afternoon, Nishant. So basically, this both the facilities in Secunderabad and Sanand, the cumulative capacity is around 250,000 tons annually. And with this, we are hopeful that in the first year we'll have a 50% utilization from these both the expanded capacities. So this is the volume growth that we are looking at from Q3 onwards. Secondly, when it comes to value addition, so both the projects are focused mainly towards high value added products, whether it is renewable energy sector side or some defense pipes that we have identified, and some special SKUs and coated products. So this added capacity is mainly in the value addition segment. So we are hopeful once these capacities come up, and we'll have a good room for our EBITDA margin growth.
So, sir, can we see this value-added products which you in your investor presentation is 37%, probably go up to, let's say, 45%, also 45% to 50%? Can you see that going forward?
Yes, for sure. We are looking upwards of 45% with this expanded capacity.
Sir, could you also clarify? So there was the volume still grew, but the top line contracted. I believe the prices were a bit of a concern. So going forward, sir, what is the optimal operating profit margin that we can see once the value-added products share start to go up?
Yeah, Nishant. So the volumes have gone up, but the total revenue has come down because of the steel price fluctuations have already compared to last year. And what we see is how the tariffs are playing in the international market, and it is having its impact on the steel prices also globally. So these prices are still not stabilized, and they are fluctuating quite rapidly. So we are keeping an eye on this, but I certainly feel the prices where we are right now operating at, these are like in the bottom range only. So I don't see any further deterioration in the steel prices from here on. And if the Indian government increases the safeguard duty, or there is any other import restriction mechanism, then that will aid the steel price hike. So we'll have to wait it out.
Got it, sir. Got it. And any impact on your order book? So to say, you're seeing because of this tariff, a lot of exporters, at least on the exporter side, I mean, people have started to see issues. But we are seeing that there is a very strong demand still in the renewable sector, which we are seeing. So any issues that you have started to foresee in your end customers' demand with the tariffs and everything, or any deferment of orders which have started to happen, or any intimation around that?
So Nishant, this is a bit interesting for our sector. So what has happened is, US has placed uniform tariff of 50% on steel and steel products across all the nations. So India is also in that 50% category like any other country. So now it's sort of a level playing field for any other country which is outside of US, which is willing to export to the US market. So we are in the same bracket. So no other country enjoys extra benefit compared to another one. So this is a slight positive for our sector, and going forward, once this dust settles of tariffs and everything, I think we will have some opportunity in the US market.
Got it. So got it. So just one final question from my side before I fall back. So what is the optimal margins that you expect, like, once the steel prices stabilize and things come back to normal? Obviously, it will take some time, but what is the optimal operating profit margins that you're targeting internally, which you can probably, share that this is something that we are looking at? It can be a long-term target, but still, what is something that you're looking at?
Jan, so, with our new product development focus, new markets, international market, now we are going in API segment. We launched new jumbo sections in last quarter. So, if the markets had been like, well aligned and perfect, 4.5 to 5,000 EBITDA is not impossible target for us. But once, this volatility comes down, I think we'll be in that range pretty shortly. But to give exact idea is, difficult right now because we see, every month, fluctuations happening. So, but once this stables and with our this new capacity that is coming up, upwards of 4,000 is not a very big deal. So we're just waiting, for things to settle down, the prices, steel prices, to stabilize.
Fine, sir. Thank you for taking my questions. I'll fall back in the queue. Thank you.
Thank you.
Nishant.
A reminder to all participants, please press star and one to ask a question. Participants, you may press star and one to ask a question. Ladies and gentlemen, please press star and one to ask a question. To ask a question, I request you to press star and one. Our next question comes from the line of Soham with RV Investments. Please go ahead.
Hello, am I audible, sir?
Yes.
Yeah. Hello, sir.
Sir, I joined in a bit late. Any guidance for FY26 on the volume side?
So, the current run rate is around 1.25 lakh tons, and this new capacity that we are operating at a pretty much, at an optimal level right now. And this with the with this commissioning of both the new facilities, we are hoping of 50% utilization from these facilities going forward. So anywhere between 5.5 lakh to 6 lakh tons is a number, is a volume number that we are looking at.
Okay, sir. Thank you.
Thank you. A reminder to all participants, you may press star and one to ask a question. Participants, please press star and one to ask a question. Our next question comes from the line of Adesh Mehta from Motilal Oswal AMC. Please go ahead.
Hello, sir. Am I audible?
Yes, sir. Good afternoon.
Good afternoon, sir. Sir, just wanted to understand, with this volume of around 124,000 tons, which we did this quarter, what do we think, and plus with the new plants also getting operational, how will the volume ramp up be, quarter on quarter going ahead? We understand that full year ramp up can be anywhere between 5.5 to 6, but what is the quarterly trajectory?
So, Adesh, we are looking at approximately 30,000 tons, from both the facilities on a quarterly basis to start with. And this will be, ramped up quarter on quarter. But this is, 30,000 we are quite confident that, in the first quarter itself, we'll do a 30,000 volume from these facilities. in the first quarter.
Oh, okay. So first quarter will be 2Q, right?
First quarter will be Q3.
Q3.
Yeah.
Okay. So 2Q will also be flattish, sir?
So Q3 will be approximately in this range. If this facility come in late of August as we are thinking, so there might be some incremental volume from this for this quarter.
Got it. Got it. So basically, even next quarter will be doing around 124,000, right?
Sir, as I said, if we are able to commission it in this month, and so we'll have one month in our hand, and we are hopeful that some quantity should come from this for this quarter
Got it.
also. But to define it number, it will be slightly difficult. It will be premature right now. But there will be definitely
Okay, sir.
there will be some addition.
Okay, sir. And sir, what is your... So we are seeing YOY, our EBITDA per ton has also corrected. What is our understanding of margins, and where can it go ahead going forward?
So, sir, there is 150 rupees per ton dip is there. This is mainly due to, sir, the steel price volatility that is happening right now. So, prices are not stable. International prices are, they went down, but even then, we have managed to not get affected by that. And,
Right.
the branding, like a lot of, the company expenditure is going in branding also. But, once this stabilizes, this will go up. And with this new, as I mentioned earlier, this, with these new two plants, this is mainly these products, from both the plants will be focused towards value-added segment. And our share of, value-added products from 37%-38% will go up to 45% with this expanded capacity. So all in all, coming quarters should be quite healthy for the company.
Got it, sir. Wish you all the best, sir.
Thank you, sir. Thank you so much.
Thank you. A reminder to all participants, please press star and one to ask a question. As there are no further questions from the participants, I now hand the conference over to Mr. Anish Bansal for the closing comments.
Thank you. On behalf of the board and the entire leadership team, I would like to extend my sincere appreciation to all our stakeholders, shareholders, employees, customers, and business partners for your unwavering trust and support. We look forward to building a stronger, more innovative, and future-ready high-tech pipes. Thank you.
Thank you, sir. On behalf of High Tech Pipes Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.